Hey, it's Richard Matthews with Matthews Wealth Management. I am in the sanctuary of my church. They're super awesome for letting me do a video here, and we're going to do our market update, which is a little delayed. It's mid-March, March 15th. Man, it's been crazy. This is going to be weird to rewind and do January or February of 2023, but it's been a while since I've done an asset class and M2 video, so here they come. So let's just jump right into it. As we've been doing with these PowerPoints, we just kind of track indices, and I'm just doing the year to date, right? And so this is going to be weird if you've been, yeah, these are always delayed, but man, so some bank failures have happened. Anyway, NASDAQ is up. What's up? This is actually current, so that's kind of cool, right? This is what we've been seeing, right, as far as SVB and so forth. But year to date, we're still up 8.75%. So as much as people are panicking, NASDAQ's doing great. Let's dive into S&P, and yep, here we go. That's what we're starting to see. But it's still up, right? S&P 500 still up. That's kind of a good average of all the different stocks in the U.S. economy. And Dow Jones Moderate Portfolio Index, which we've been tracking last year, was the 60/40 that took the nosedive here. They're still up 1.66, and that's accounting for a lot of the bond volatility that is going on with interest rates and the concerns there. But let me flip on over here. You can see the scare, right? I mean, has it really hurt? NASDAQ's helping everybody out, so everybody flooding into tech money, and we'll see why here in a little bit. But we'll cover the U.S. equities positions. We've got large cap value, core growth, mid cap value, core growth, small cap value, core growth. And what I've got here is February at the top, and year to date, meaning January and February, in the green. I don't have anything in March in these numbers. I just showed you including March in the previous numbers, but let's just get a snapshot, right? So February, all reds, right? If you notice the top on all of them, all reds. If you notice something that's remained green, that means it had an amazingly good January. So we started off this year with a huge upside, and February started to look rough, and March is even more interesting. But the thing that stands out the most here is core down 4, value down, and growth not so much. And again, I'll tell you where this NASDAQ push is coming from. Same thing on the mids. You got the highest loss in the value. And the same thing in the smalls, the highest percentage losses in value. So kind of interesting. But then on the flip side, you can see the gains, the huge gains were made in small growth and growth in general. Large blend's been pretty much the worst, right? So it's very sector heavy as to where returns are and losses, I guess, for that matter. But yeah, that's kind of a strange Christmassy 2 months there. Let's see, international and emerging markets. Again, rough February, great January. You know, if you lose 6.5% and you're still up by 1, it just shows that there's some volatility happening around here, and that's the gist of it here. Let's get into bonds. Bonds are all up year to date and all down in February. So again, it's all about interest rate risk. Now, if you can rewind to what it was like to live pre SVB collapse, and now the fears of whether the Fed can continue raising interest rates, because that is the underlying issue. Go see our video about SVB that we did yesterday, 2 days ago, whenever I did it. But yeah, so we've got big losses in long-term bonds. You know, it actually lines up. These correlations are good. That's how it should be. But the concerns in February were that the Fed was 80% likely to raise rates in March by 50 basis points. That's changed in the last week to 0. With actually, I think now they're pricing in 60 basis point rate cut by September based on what's happened. So trying to put my mind back where it was previous to all the studying and learning I've done over the mark-to-market accounting and the financials and the risks that we're facing in that sector. But anyway, this is normal, and this was predicated on, hey, inflation's still running a little high. They're stuck. Let's see, commodities. We got oil down and down, and that's going to be a demand-based down. Gold is still up on the year, but a big hit when we were expecting a 50 basis point rate hike. I will say that in the last 2 weeks, we are up a significant amount in gold. So it's weird to look back at these, but I'm trying to do this. Yeah, I'm not trying at all to not include recent information, but this is as of the end of February. Yeah, in real estate, still up, but down. Just a big bump. That's it. January was up, February was down, March has been crazy. All right, so let's cover the indices. We've got NASDAQ up 8.75, S&P 3.69, a moderate, half stocks, half bonds, 166, and as a practice, we're only up 1.61, so we did not participate on the high upside. In the last couple of weeks, we have not participated as much on the downside, so I think we're positioned properly for where we wanted to be. I've mentioned a lot of dollar cost averaging into long-term bonds. We did that actually February 13th, I believe, was when we did a large move. We're about 70% dollar cost averaged in at this point. Just for the clients that want to know, when am I going to see more trades? They're probably coming fairly soon. But yeah, so this is the gist of how we've done and how the indices have done from January, February, and hopefully that is helpful. Yeah, if you got questions, follow up. I'll try to keep doing these. It's hard without the office, guys. So I've got the downtown Greenville office, but the setup time and all that takes forever. It's a 30-minute drive, so hit and miss when I'll be able to get these rolling again. But again, I try to do them monthly, and if not, we'll do a big catch up. So good luck in March, and we'll see you next time.